So PepsiCo just reported their Q1 24 earnings beat on top and bottom line. We can see their EPS beats by 9 cents. Their revenue beat by 140 million, and they're consistent with its previous guidance for 2024. So one thing that was in here that as I went through their earnings report, keep this in mind that the total cash return to shareholders is approximately $8.2 billion, $7.2 billion in dividends, $1 billion in share repurchase program there. So just kind of keep that in the back of your mind once we go to the overall financials on this company, because I think that is something to pay a little bit close attention to in this business right now. So overall, Pepsi, after reporting earnings, is down 2.2%. Year to date, company is up, 1%. Over the course of 1 year, down about 4.5 or 4.8% there. So also another thing I found, I was able to grab this article before they deleted it from the website. Here you can see there's a timestamp of 6:39. This came from Seeking Alpha here, and they either revised it into this one or they deleted it entirely. But in this particular article, I found it. I was able to get it back. So they had a recall early in the quarter of the Quaker Oats cereal bars. They potentially had contamination with salmonella. So because of that, the food sales dropped 24% in the quarter. So that impacted their overall revenues a little bit, quite a bit probably. And then also because of their vendors increasing their pricing, they also have to increase their pricing. And with that, when PepsiCo was increasing their pricing, one of Europe's largest supermarket chains announced in January that it was pulling Pepsi's products from store shelves in France, Belgium, Spain, and Italy due to unacceptable price increases. So after that, the two companies resolved their pricing dispute, and now they are restocking Pepsi's products back on the shelves in early April. So they had this going on, and they also had the salmonella issue going on in the Quaker Oats cereal bars. So two relatively major things there that impacted their overall revenues for this particular quarter. So now over to our valuation spreadsheet. Let's take a look at how the performance of Pepsi has been over the past 9 years here. And we can see on our revenue, which is the blue line here, has up until 2020 was pretty stagnant, and then 2020 hit and grew quite a bit, and now it looks like we're going back to potential like a stagnation type, revenue growth where it's very minimal to none. We also have net income. We can see a little spiky here, but it seems to be also leveling off a bit over there as well. Margins pretty flat, slightly down from 2015 till today. Net margins 8.6, sitting at about 10, so pretty stable around 10% net margins there. Then we come down here to return on invested capital, 17.7%, very good. PE ratio, kind of on the upper end of the PE ratio there, sitting at about a 27 PE, and historically you can kind of see it's about an average historical PE on this one. Cash and short-term debt, this is something we're going to want to dig deeper into on their 10Q once we get over to it, and just to understand their debt position and see why they have so little cash in comparison to debt. And we can see cash to short-term debt in general is on a trajectory higher, whereas their cash position is on a trajectory much lower. Same thing with over here in total liabilities, continues to go higher in debt and lower in cash. And on such a big business like this, not something that you probably want to see. Earnings yield sitting at about 4%. Net income to free cash flow, pretty consistent. You got more net income than free cash flows almost on every quarter here. And then over here, free cash flows on its own page. Actually 2015 till today, our cash flows are identical. And then capital expenditures sitting at $5.5 billion in CapEx. Share count dilution, they are buying back shares. They do have a little bit of a share buyback program, which we just showed over here. We can see they got about $1 billion in share buybacks going on. So then that, they will continue to buy back shares. So we should see a share count dilution happening, reduction in share count overall over the course of this year at least. And we got dividends that they continue to increase year over year as well. So over here to the 10Q that they reported today. This is today's report. We got net revenues sitting at $8.2 billion. And this is in a quarterly report. And this is year over year comparison. And we come down here, net margins. This time last year, they did about 10.8% net margin. This time now they're getting some of their margin back. They're at 11.2% this quarter. And overall down here, we can see their shares. They are currently buying back shares. We see a small reduction in overall share count. Then down here to cash flows. So on the cash flows, we got our net income, $2.05 billion. And we scroll down here, we had a huge hit to our overall cash flows from accounts payable and other current liabilities. So from short-term debt. So they had to pay out, $3.4 billion in total to cover some of these debts that were due. This time last year, they also had a similar situation, not nearly as bad, but it was $2.2 billion. Obviously, once you subtract out that $3.4 billion from $2 billion in net income, now you're negative on overall cash from operations. Same thing happened last year where they had a big hit to overall accounts payable and other current liabilities. So I think this is a column to potentially break down further into previous quarters to see if this is an ongoing issue that's happening within this business. And if so, that might warrant something, a good reason to maybe step out of this stock or maybe just stay on the sidelines until this turns around, because if this continues, that's going to eat into their cash position, and then they're not going to have much cash. They're going to have to raise more capital or potentially issue more shares to afford to pay their vendors. And this also could potentially be from supplier price increases, why we're seeing such a huge increase in our accounts payable. That's why we're seeing negative cash flows right now, free cash flows and cash flows. But then we add in our capital expenditures, and then overall that gives us a negative $1.6 billion free cash flow just this quarter. And then last year we were at negative $1 billion free cash flow as well. So obviously that's not ideal for dividend payouts because they don't have the cash to afford to pay out these dividends, but they do have a sufficient amount of retained earnings as well on their balance sheet. And down to their balance sheet, we have current assets. So we have $8 billion in cash, $300 million in short-term investments. This time last year, we had in total about $10 billion in cash. So we burned through $1.7 billion of cash. And basically, we can see that burn was from our free cash flows. So we negative $1.6 billion in free cash flows. That's going to show up over here because they had to take that money from their overall bank account to pay out their vendors, basically. So then we come down here, we got current liabilities, which is what we're looking at up there in the cash flows. That's where that $3 billion hit came from, is right here. We had $8.3 billion in cash. We have $30 billion in short-term debt. So we add 8 plus 22. Obviously, we got $30 billion in total current liabilities, which are due in 12 months. And then we've got, that leaves us with a 0.27 short-term debt to cash ratio. Basically a 1.0 or more is good, or a safe, balance sheet. So in this case, this is not a very safe or good balance sheet, at least at the current state. Then we come down here, we got retained earnings. We can see retained earnings, $70 billion of retained earnings. So at least going forward, the dividend payout should be safe. And we can have a little breakdown here on the retained earnings. We got our balance of 70 billion. Net income that they had minus $1.7 billion of cash payouts or dividend payouts still leaves them with a little bit higher retained earnings amount there. So, and then going back to the cash flows here as well, we want to see what they've done with their debts. So, financing activities column here, the proceeds from issuance of long-term debt. So they issued more long-term debt. They repaid back some long-term debt. So basically they netted out positive $500 million there of debts. And then more than 3 months proceeds. They also had more short-term borrowing, so they had to borrow more money. They paid back some more of that money, not as much. So they got another net of like $7 million there. And we can see that 3 months or less net, $7 million or $700 million, sorry. And then cash dividends paid out 1.7, share repurchases $146 million. So overall, in their overall cash provided by operating or financing activities, basically flat. And they borrowed a ton of money, paid back some money as well, but they're just kind of, it's like a revolving door of credit that it seems like they're utilizing right here, at least in the most recent quarter. This time last year, they did something similar on long-term debt as well, except they borrowed more they paid back about the same amount, but they borrowed more this time last year. So I think they got maybe some little financial issues. Maybe it's from acquisitions or something like that. They're trying to issue more debt, but it's just the balance sheet and the financials on this company for me. I don't like. So over to the comps, we have Coca-Cola and Monster that I feel is a good comparison to this company. So we'll come down here to the comps and see how these two companies compare to Pepsi. So we got our charts, we got market cap and revenue comparisons. Coca-Cola, obviously pretty well, it's probably its main competitor, right? We got our revenue, gross profit, and net income charts. And then we come down here to margins. We can see margins on all three businesses, very, very tight. Operating margins overall, though, we can see much better on Monster and Coca-Cola. Profit margins, similar story. That Coca-Cola, Monster, much better margins. Free cash flow, Monster not as good, but Coca-Cola, pretty good free cash flow. And also Monster is a significantly smaller company business than what these other two are. We can see right here. So cash flows, we shouldn't expect to see them beating these two. But, in comparison, when you look at market cap and just overall revenues, that the fact that Monster is even positive is pretty good. Return on invested capital overall, pretty good across the board. PE ratio, Monster you can pay a bit of a premium for, but that is a pretty fast growing company right now. So even at a 10 more multiple than these other two is probably still pretty fairly valued on Monster. Earnings yield, similar story as well. So overall, all these businesses, all three of these businesses are in the same area except for margins here. You know, gross margins are good, but operating and profit margins not as good on Pepsi, and that's kind of unfortunate because I feel like they should be a lot better. Coca-Cola's and Monster both have much better margins, which means they can pull more money into their free cash flows and cover and pay for dividends and other things going down the road. So now to our calculator, let's figure out what Pepsi is worth. So right off the bat, we got P-Lunch valuation gives them a value of $89.23 per share. Go over here to multiples comparison for Coca-Cola and Monster. It gives us a price tag of $193.42. We got a price to book ratio, 12.67, 5-year average, 13.95. So cheap on the 5-year price to book at least. We do have a PEG ratio sitting at about 4.2. They just don't have much of a growth rate. Grams valuation, $166.27. Dividend discount model, $174.21. Over to our discounted cash flow valuation. So analysts have a growth rate on their free cash flow of 22%. I am not going to match that. I put in 10% for a free cash flow growth rate, only because historically here, we got -12, positive 18, 10, 20, -20, positive 41. So it's kind of all over the board. So I'm gonna give them with a 10% right down the middle type growth rate here. And that gives us a DCF price per share of $237.54. I feel like that's a pretty fair free cash flow growth rate. Then we come down here to Rule 72. We have three sources of EPS growth rate for an average of about 10% growth. And then we get to double our current EPS 1.4 times, which gives us about a future EPS roughly of 18. That gives us a fair value today of $91.72. So over here to our summary, our final valuation, and we added all these valuations up and get an average fair market value based on all of the valuations we just went over of $158.70, 30% margin of safety, $111, and analysts have a price target on this one of about $189 per share. So then we come to the stock chart. So again, we just got a valuation of about $159 per share based on what we have. So what we're seeing over here in the stock chart, we have this blue line that's going all the way back to early of 09, and we've got this trend line. So every time it hits this trend line, it bounces off of it. It goes up higher. And we haven't touched this trend line in quite some time, and Pepsi is running into some headwinds, at least for the shorter term. They still have some issues, some price issues. They've got a little bit of work to do on their margins. Their revenue seems to be flatlining as well. So I think they've got some short-term issues where we might actually see a bigger pullback in Pepsi, where we could potentially come back down to this green line, which to me looks like, at least in this green, between these two green lines, 130 to 150 range is a potential area where you could find some buyers if this thing decides to pull back. You could potentially see support here at 150, depending on how quickly it gets back to there. And as of right now, it is rejecting this red line, which is telling us we are making lower highs, made another lower high, and we might continue and at least come back down to 155 range, which would be in the range of our fair market value on Pepsi right now. And if it does come back down to 155, that could be a potential buying opportunity if these financials can get cleaned up and straightened out and start to look a little bit better. Right now, I think the financials aren't that great for such a large company. I think this is one for me at least to stay away from until the financials want to start turning around and and start showing positive free cash flows. As of right now, they're not showing positive free cash flows, which is, in my opinion, a bit of concern. But that is it for Pepsi. If you found value in this video, drop a like, subscribe, and comment. We'll be back later with another stock analysis video.